we've obviously seen, we talk inflation, and obviously very heavily impacts the bond market. And we've seen, as you've talked about there, the sort of the where rates got to in the recovery post COVID up to its September, October peaks, and then gradually wound their way back. And we had another sort of jump around earlier this year.
Yes. So,
what are you seeing for portfolios with regard to bonds, given where we're at with the longer term rates?
So in every portfolio in the every diversified portfolio in the world is basically shares, being the growth assets for a property, but primarily shares in companies, listed companies, unlisted companies. And the defensive side of portfolios, whatever your portfolio is, the defensive side traditionally has been stacked with fixed rate bonds, government bonds, corporate bonds, high grade. The problem with bonds is that there's two or three problems with bonds. One is that the bond yields are being artificially kept so low for so long that the only way to go is up. Australian long-term bond yields are about 10-year bond yields of 115, 120 odd, but they were nearly 1% higher than that now earlier this year. So if I was to buy a bond, first of all, the only way for a bond yield to go is up, and therefore the only way, every bond in the world is priced, the bonds in the world are sold at $100 and they trade at around about $100, give or take. And at the end of the maturity date in 5, 6, 7, 20 years time, you get your $100 back. Every bond in the world, in every market, in every sector of every market in the world is trading above $100, which means if you buy a bond today, you will lose money, guaranteed to lose money, because you've got to, all you get back is $100. The second problem is that the coupon, the actual interest rate they pay, you and I were growing up, the interest rates were 3, 4, 4.5. The average Australian government bond was a 4.75% yielding bond, and it would pay back $100 in 10 years. That bond is now yielding about 1.5% around the world. So you're not getting the interest rate on that to buy veggies every month that you were 10, 15 years ago. And the second problem with bonds, just a bit of technicality here, is most of the bonds in the world are global. So our global bonds are hedged into Australian dollars. So we get a nice little return on the foreign exchange hedge of about 3% per year, free money, because our inflation is higher in Australia. So we don't get a hedge return.
That's gone. Yep.
We don't get any coupon. The interest rate the bonds pay is 1%, not 4 or 5%. And thirdly, the only way for the capital value of a bond to go is down, because you're only going to get $100 back. So in our portfolios for the last 3 or 4 years, we've deliberately been underweight. We're carrying less fixed rate bonds than we ordinarily would do. And what we're going to do, about a third of our defensive holding has been non-fixed rate bonds. It's been floating rate bonds. Now, floating rate bonds go up in value when rates rise. Fixed rate bonds, which is your traditional government bonds, the value goes down when interest rates rise. So we are in the middle now of basically removing most of our fixed rate exposure from portfolios. It's a good time to do it now because bond yields have collapsed and the bond markets have returned about 1% return every month for the last 2 or 3 months, which is good. They sold up a bit in January, February, in March because of the bond yield spike. Bond prices have come back up and bond yields have come down to quite low levels. And unless we have, I think if we have a GFC, i.e. a systemic banking crisis where banks close, like they almost did in the GFC, and if we also have government's inability to spend money, then we would have a situation where bond yields would collapse and we'd have an almighty depression type recession. I don't think it's going to happen because we haven't yet seen a systemic banking crisis like Lehman Brothers almost triggered. And even back then, banks jumped on the bandwagon and bailed out banks. So they'll certainly do it again in half an hour. They'll simply say, let's buy every bank in the world. So I don't see a systemic banking crisis occurring. And secondly, that would require a lack of government response. And I can't see that either. I think governments have been taught post-GFC to bail out everything. And they've got the ability to bail out everything. So I don't see that. That's the only situation I can see where bond yields would collapse to 50 basis points or 0.5%. They're currently around about 1%. So given that that's quite an unlikely scenario, i.e. a Great Depression without governments to help, I don't see that occurring. So therefore, the only way for bond yields to go is up, particularly since spending is creating inflation and jobs growth, which it is around the world. So in that environment, it's a good time now to sell some of the bonds that you've got, because they're actually
sell the fixed rate bonds, go to floating and protect the capital.
We were about a floating rate, which is good when rates rise, and about 2/3 fixed rate. We're going to move in the next few days or over the next week in this cycle. We're going to move to far less fixed rate exposure, so we're less exposed to rising inflation and rising rates in the medium term.